Hey, everybody, welcome back to the Financial Advisors Workshop. We have a really interesting gentleman brethren in our industry, in the financial advisory industry, and he's a partner and CEO with Gitterman Wealth. It's Jeff Gitterman from New York. Jeff, welcome to the show today.
Thanks for having me today, Brian.
Great. Now, you've been an advisor for 35 years. You've got about 600 million under management, or at least that's what the sheet said, about 100 clients. But it's really a unique story. So give us your background first, Jeff. How did you get into business? And then fast forward to like the last 10 years, because that's really been impactful. So start there.
Yeah, I could be quick on it. Got into the business because my parents were poor and struggling, and my uncle was an insurance salesman and worked 3 days a month. And I just saw that life versus my parents and kind of followed him. So started my career at Equitable back in 1989, actually, after doing some operation stuff at Merrill Lynch, but went into sales at Equitable.
Okay.
And loved the investment side more than the insurance side, so always tracked that way. But in 1991, Richard Wildman, who was still floating around there somewhere, believe it or not, he was doing a target marketing course that the insurance companies would bring you in to talk about. And 50 guys took the course. I think there was one woman in the class. And he said my ideal target market, you do like a psychological profile, would be college professors. And I was looking for a target market. I had read Tom Stanley's book, Marketing to the Affluent, right before this class. And college professors fit an ideal target market. Usually two people working, there's networks, shared newsletters, shared conferences. So that was a lot of the themes around a good target market. And my profile came out, said I would be good with teachers. And out of 50 people in that class, I was the only one that listened to the advice of Richard Wildman. So I thank him publicly now.
So did you start with college professors early on?
Yeah. I literally dove right in. I started offering like in New Jersey colleges, supplemental benefits, life insurance, long-term care, just trying to work my way into it. And then just because we were in there and knew a lot of people, by 1996, the state of New Jersey opened up the pension system from just TIA-CREF since 1952 to allow alternative carriers in. And we won one of the slots as an alternative carrier. So we've been in the New Jersey college pension system since 1996.
Wow.
Competing with TI-CREF, basically. Tough competition, but we've done a good job.
Now you have a program called SMART, right? Is that part of the analytics that go into the pension business like that?
Yeah, it goes into both that. And so the pension business is separate from our AUM. That's another 700 million roughly that we manage inside the pension on top of the 600 billion that we advise and directly on discretion. But yeah, we run sustainable metrics applied to risk tolerance. So basically, before it was popular and before it became ESG and got bastardized by BlackRock and Vanguard and everyone, we were looking for companies that had more sustainable practices, were treating the environment well, treating their employees well, and doing good governance, which, the weird thing about throwing ESG out is the G is governance. And I don't know why anyone would want to throw out good governance companies. But regardless of that, we were focused on that early on, and it's still part of our practice. And ESG done right is just a diligence tool. It's not a screening process. So we use it as that, as it was meant to be. We use it as additional diligence to find good companies within every industry. You could have an ESG portfolio that's all fossil fuel companies. There's no actual screening methodology in ESG data. But anyway, so yes, we've been running those models, and it was really out of a deep interest jumping into the last 10 years. In 2014, I made helped produce a film called Planetary. And it was with Bill McKibben and Paul Hawken, the original guys that actually were working with George Bush Sr. when he ran his campaign on greenhouse gas emissions, and the guys who were talking to him about climate. And climate started as a Republican platform, and we got deeply interested in the impact of a warming planet on capital markets assets. So not coming at it from a, divestment world where you have to eliminate all fossil fuels, not trying to push for that. Obviously, we need fossil fuels for lots of things, but really looking at it from a point of view of if the planet keeps getting warmer, what will happen? What will be the impact? And I wrote a seminal paper in 19 called The Great Repricing that basically covers risk from climate change in the capital markets. And I wrote that with a lot of large asset management firms, Alliance Bernstein, PIMCO, a slew of firms combined to write that paper.
So after you wrote the paper, you've turned that into quite a media career, haven't you? So tell us about that. You're on the floor of the New York Stock Exchange and everywhere else.
Yeah, I started running conferences at the UN on the Sustainable Development Goals. That translated into a TV show on the floor of the New York Stock Exchange called The Impact, which airs on fintech.tv. It streams, also airs on Reach TV, which is all the airports in the United States and hotels. So it's got a decent distribution. But we cover impact stories, which is really, again, not ESG or sustainability. It's people in the world making an impact on a better planet, whatever that means. Helping people who are starving, getting rid of fast fashion. We've covered 200 topics in the last couple of years on the show. And I guess this all boils down to, because we're talking to financial advisors today, is if you're just going to be a jack of all trades, you're competing with everyone. If you're going to pick something that you're going to become an expert in, then you should become an expert in it, and you should do it because you're passionate about it. And this is something that I'm passionate about, and I've studied now for 10 years and become somewhat of an expert in it. Because you can't win clients by pretending to be interested in something.
So you got to be a believer.
Yeah. Yeah. Whatever it is, I mean, you want to network in the NRA and network for good gun control, whatever it is, but it can't be something that you're faking because you think there's a bunch of rich people over there. And if you network into their association or club, you'll get seen pretty quickly. You have to do it because you're interested and you're passionate and you want to give back to your community in whatever way that might be. And that's how you should develop an expertise and then learn how to share that on LinkedIn. I mean, it's not a ton, but I have 8,500 followers on LinkedIn that follow me pretty regularly. I post about this specific topic pretty broadly. Insurance risk, I'm very focused on that. And it builds a loyalty and it helps you grow customers over time. It's not an instantaneous thing, as you know, doing a podcast. So you have to commit to it. A lot of advisors will be like, well, how can I get ROI in 6 months? And, building a target market and cultivating an expertise isn't a 6-month thing. It's a lifelong journey.
Doesn't work that way. That's right.
Yeah.
Well, I would say, though, this is quite an interesting group, because if I had to think of college professors, I wouldn't have thought that would be an upper crust crowd to get clients from, but it actually turns out it is, and they're also making some good money these days.
Yeah, it's an interesting thing, especially in New Jersey. It wouldn't maybe work in every state, but New Jersey is one of the highest paid college professional marketplaces in the country. The college pension system in New Jersey right now is about $13 billion, and that's just the state and community colleges. It does not include private universities or private colleges. So it's a big, robust market, 30,000 employees. Average net worth of a retiring college professor is between 2 and 3 million of investable assets, because they're forced to put money in their pension their entire career. They stay usually in their career for 40 years before they retire. So they're putting away at least 13% of their salary, plus they could do voluntary on top of that for 40 years. And college professors, unlike a lot of other segments of the market, don't spend more than they make. Obviously, there's exceptions to every rule, but in general, our college professors, and I've been doing this 35 years, all live on about a 4% distribution rate in retirement, and leave a decent amount of money to their kids.
Yes, very nice. So how has that business developed? Is it do you find working that market with college professors that are climate activist types that they're interested in what you're doing?
I would say this. College professors think climate change is real, so it certainly helps that my expertise isn't something that the majority of college professors you'll find in the US do think that. I mean, obviously there's exceptions to that as well. A lot of geologists out there who don't think so, but regardless, it's worked well for us. There's never a client that says, "Oh, that's a hoax." That's a college professor. And we address climate risk in a very specific way. We look at building more sustainable infrastructure, water, which is a huge theme, which you don't even have to believe in climate change to know that we're having issues with water in this country, whether it's the Colorado Basin or, cities like Mexico City or Barcelona running out of water. So that is one of our thematic themes, and adaptation and resilience, which is doing incredibly well because people are buying more air conditioners than they ever did because there are more heat waves. They're converting to heat pumps. They're buying water purification systems because post hurricanes and storms are having huge issues with clean water. Look at Asheville, North Carolina. So we're not out there as like climate activists. You have to divest your whole portfolio. You can't. You have to buy everything green. We don't own any clean energy right now in our portfolios because it's just not a cyclical market. High interest rates kill clean energy projects. So we're very thematic and specific about it, and we wrap that around core portfolios. And our clients appreciate it and believe in what we're doing and see the results of it too.
But you're technical in that sense, like you say. If you don't hold, if the clean energy is getting rocked, you might sell off for a little bit, right?
Right. Yes.
So you're managing the portfolios in the right way. And
yeah, you have to be a fiduciary first. You can't be too passionate about something and dig yourself a hole. That doesn't work. And a lot of advisors who went too hard in on whether it's ESG or sustainability have had problems because of that. Clients like the idea until about 6 months of poor performance, and then even the most devout climate change activists will turn on you if you're underperforming the markets by too much in 6 months.
That's right. We all want performance, don't we?
Yes, everyone, especially our group. To be fair, in the high net worth, they will invest in things thematically with the understanding that they might lose money, but they can afford to. In the mass affluent to high net worth marketplace, you have to be cognizant that returns matter.
Yeah.
Yeah.
Well, and I was going to say, the ESG, which you're very much involved in, it took our industry by storm, and that was after a socially responsible SRO. There's all these different buzzwords and buzz phrases. So there's a little bit of backlash now because some went too far. So how does that play out in your world?
To us, ESG was always a diligence process and not an investment theme or product. It never should have been a product. The companies that won't name names that created product labels around ESG were sorely mistaken and misleading clients because ESG is not an investment theme. The alpha that people were claiming on ESG was because it was underweight fossil fuels for years where fossil fuels underperformed, and it was overweight overweight technology, which outperformed. So you had these ESG kind of themed categories were outperforming the benchmarks until it didn't work anymore. And oddly, during the Biden administration, fossil fuels did great, clean tech did horrible. Under Trump, fossil fuels did horrible, clean tech did great. So you can't always predict based on who's the president, what themes will work out or won't work out. But ESG is just a diligence tool. It looks at the environmental impact on the companies that you're investing in. It looks at, do the employees like working there? I mean, if you've got 500 complaints on Glassdoor about a company, is that a company you really want to invest in if most of the employees hate working there? And good governance. And I don't know anyone in their right mind that wants to throw out governance in evaluating companies that they're investing in. So it just, as you know, the pendulum always swings too far in one direction, and the left took it way too far in claiming alpha with ESG. The right is taking it too far, claiming that ESG is a values-based modeling system, which it's not. You can run an entirely fossil fuel portfolio with ESG criteria and pick the best fossil fuel companies.
Mhm.
It is not a screening tool on values. It's not. I like to say ESG is looking for value, not values.
That's an interesting perspective because that's not really what we hear in the national media, right?
Not at all.
So there's the overdue, and then there's the backlash, and there's this debate. And yeah, great perspective, Jeff. We appreciate your sharing that with us.
Thank
And
you.
we'll see. So maybe some of our advisors will start to take another look at it and not be so one sided, either one way or the other. You know.
85% of stock performance today is based on non-financial disclosure items.
Mhm.
ESG is just data on those non-financial disclosure items. It's not a value selection process. So if you ignore all of it, you're ignoring 85% of what makes up valuations in the stock market today, the S&P 500 specifically.
Yes, absolutely. Wow. Oh, well, that's great. Well, good. So how has business growth been then? It's been pretty good with your crowd of investors.
Yeah, and I mean, college professors are an aging population, so more and more are retiring. We built a great funnel system because we got them while they were working in the colleges, and as they retired, moves out of pension business into asset management business. So we don't have to market a lot outside of the firm. We just have a natural kind of transition within the firm. As a young advisor, what I would recommend people is, try to get into a 401k plan at a big company or a defined contribution plan and work that as part of your practice early on. And that will mature later on in your practice to lots of rewards. It's like planting trees and, 10 years down the road, 15 years down the road, all of a sudden there's all this fruit to harvest.
Right. That's awesome. So Jeff, you've done the Impact Show now. You said over 200 episodes, and you've done quite a few, and doing down on the floor of the New York Stock Exchange. So, how has that helped you develop? Like, what's the process? You do a show, and then people call in, or how do you mind?
No. Yeah, people don't call in, but it's twofold. One is I'm having guests on the show that I think are doing interesting work in the world that I want to learn more about.
Yep.
So every week I get to deep dive on fusion, nuclear, clean energy, hydrogen, fast fashion. It's literally a plethora of things that I could look at. Regenerative ag. I can learn about anything I want because I reach out to an expert and say, you want to come on the floor of the New York Stock Exchange and have an interview that you could publish on your website and everything. It's a news-based show, so it's no charge for guests to come on, and they get to distribute that themselves, and we distribute it on our side. And we distribute that to clients as well and other advisors. I've got about 14,000 advisors on my mailing list that we send the shows to weekly. So we get to educate people on really interesting topics. And then that drips down into our asset management because we'll find things that we're really interested in. Then we'll deeper dive on it through our investment committee, and we'll find investments that we want to make because we hear from experts about what trends are going on in the industry. So it's been super helpful. And then the show gets out there. We push it out on LinkedIn, and we've become known as, experts in physical risk of climate change and its impacts on the capital markets.
Interesting. So, what role do you think the media plays in the perception of sustainable finance? Are they they're really impactful?
What's interesting is that shows like ours are all of a sudden getting a lot of attention because no one trusts mainstream media anymore because it's all bought and paid for. So streaming shows, which is what we've been doing since 19, are getting incredibly popular because people know that they could come on and I don't have a weighted opinion that a corporate is telling me. I'm literally deeply interested in the subject. I want to ask probing questions. I want to learn about it, and I want to educate the consumers. And I don't have a predisposed opinion of it's right or it's left. And that's what it's got to be. We want to be right down the middle and have nuanced topic conversations about things that people are only hearing in their echo chamber, one side of the sound bites on CNN or Fox or whatever it might be. So I think streaming media, I don't think it's already growing tremendously while commercial media is getting killed on advertising and other metrics. So I think it's incredibly important to educate people and to find more down the middle shows.
Yeah.
Remember
So
point counterpoint? Like what happened to that stuff? Like no more do we have two people that disagree with each other talk on a show anymore.
one way or the other, these days.
Terrible. Yeah.
So you have a measured approach then to ESG, and it's the way you believe it should have been originally. What do you see as the future of ESG and climate focused investing in the next 10 years?
You know, we've been writing about this for a long time, and unfortunately, it's coming true quicker than we thought. What we said since 17 is that reinsurance companies will have to keep pricing in higher claims. Insurance companies that get past those costs to have state regulation and can't pass those costs on to their consumers. So state insurance companies will start exiting markets that are too risky. And again, we wrote this years ago. And it all started happening in 20, and it's been getting worse every year, whether it's California, Florida, Louisiana. They're all having issues with homeowners insurance. Ultimately, that risk drives into municipal bond and mortgage risk as well, because if you don't have insurance, you can't do projects, you can't build, you can't sell homes. Florida's having huge problems because they have the condo surcharges hitting because of the Surfside collapse, as well as they're having issues around reinsurance due to Milton and Helene, which rolled through. So it's this domino effect that we've been predicting for years. We thought it wouldn't really start happening, honestly, till 2030. And when we first started writing this in 2017, it all started happening in 2020. So we've been right, and we keep publishing about it. And unfortunately, we keep being right about it. This is one case I wish I was wrong. And a lot of times people argue about climate change and what causes it and what's real. We're not looking at that. We're looking at what are the actual impacts in the capital markets that are occurring today, not 50 years from now. And insurance companies leaving markets, people aren't focused enough on the domino effect that that has on the capital markets and local communities. So it's something you really have to pay attention to, and it's only going to get worse.
Yes. Well, and with that view, where do you think your firm will be? The pension business, the 700, and then the private client business. Where is that all going to go in the next, say, 10 years?
I mean, the pension business will move over to the asset management because our client is an aging book that is retiring. Thankfully, college professors leave all their principal to their kids, and we have younger advisors that work in the firm, which is the other thing. I would say the biggest problem in our industry right now is senior advisors not bringing on training and paying the cost to bring on junior advisors that can service the next generation. I think it's the biggest gap this industry has right now.
Right.
Because the retention rate, as you probably know, when you don't have junior advisors, is about 6% when the second spouse dies. We retain about 85% of client assets. So critical. So we'll have a lot of younger advisors. We keep recruiting into that space, and we keep, finding interesting ways to reach the kids of our clients.
How many younger advisors do you have?
4 right now.
4. Okay. Do you have any older advisors?
Yeah, 1, 2, 3, 4 older advisors and 4 younger advisors. Yeah.
So a total of about 8.
Yeah.
8. But okay. Good. And do you see the younger advisors do things differently than the older advisors?
Yes, definitely. I mean, very thematic. So we run thematic ETF models for the younger advisors to service their clients with, because the younger clients want to know that they've got some money in Bitcoin. They want to know they have some money in cybersecurity. They have some money in renewable energy, maybe. So we run thematic ETF models for the younger advisors that are very aggressive and aren't for the older clients, but for the younger clients, it keeps them interested and excited. And we do, reporting on why we think certain themes are going to do well. Nuclear is one of the themes that we've been covering, and it's done incredibly well this year. Yeah.
So then how do the older advisors and older clients relate to the climate activism and the whole ecosystem you guys are in? They just consume it differently?
It's so interesting. A lot of times they say to us, that's not really for me, but my kids would love that. We hear that sometimes. Most of our clients are on board with the climate side of it, but the ones that aren't, they'll still, all of a sudden their grandchild will come home from school and start talking about plastic straws. And they're like, oh God. And we'll get a call. Can you talk to my grandson about his UMA account? But we do that because a lot of senior advisors walk away from that business because it's too small. And it is for me, maybe, but it's not too small for our junior advisors to go out and work. So our junior advisors work with the kids and grandkids of our clients. And then ultimately they build books and can afford, as our senior advisors retire, to take over the books and do a payout with the senior advisor of those books of business. But yeah, they do consume differently. Younger people are, I mean, the numbers are staggering. How many young people own Bitcoin versus how many over 50 people own Bitcoin? I mean, it's like a complete upside down. It's like 80% of people under 50 have some exposure, and less than 6% of people over 50 have any exposure to it. So you have to serve the client. And we try our best to do that, to keep them engaged.
That's great. Well, turning to generally in our industry, I think we're falling into a recession right now, or Trump may force a recession through cutting spending and things like that. What do you see as the outlook for the next few years and then over the next decade? Will America still be the dominant firm or country that it's been, or where do you see us going?
It's very difficult to discount U.S. ingenuity. Our access to private capital is better than any other country in the world, and that fuels ingenuity. And we're in a time like we were in 1999, where new technology is coming to market so fast, whether it's AI or quantum computing or cryptocurrency. I mean, all of these markets, the U.S. has a way to channel money to those projects better than any country in the world.
Mm-hmm.
And as long as we can keep doing that, we will stay leaders. Trump's policies will most likely be inflationary, and we have been real hawks as opposed to, Powell since the beginning. So we really thought he wasn't raising fast enough in the beginning. We think he's cutting too much now. And obviously yesterday he kind of came more on our side of the coin. There's just a lot of risk in tariffs and reducing immigration that is inflationary. And if the next 4 years is going to be about that, it will drive inflation. So you have to be wary of how you're investing in an inflationary environment, which means large cap growth will probably continue to be dominant because they have the cash and the capital to survive higher interest rates. It means small caps will probably continue to underperform. It means emerging markets are risky when you're looking at tariffs and reducing immigration. So I think you have to think, part economist, part salesperson in this business at all times, because you can't be wrong for long with clients. They have about a 6-month history, but you have to have an understanding of why you're making the decisions that you're making. And you have to be pretty open about, I mean, we put our quarterly commentary out on our website. We leave it up there so people could go back over the last, 4 or 5 years and see if we were right or not about what we thought was coming. We don't write about what happened. We write every quarter about what we think is next.
Right.
You have to take a position. You'll be wrong sometimes, but if you're educated, and if you're not, then you should be using models from someone else. I mean, as a short plug, we do outsource our models to other advisors around the country, as well as dealing direct with clients.
Nice. So today we're taping on the day when Powell and company lowered rates for the third time, another quarter of a point. And it sounds to me like you think they're risking inflation coming back.
I mean, if you read his commentary, he's saying that they're nervous. And I think it's also a policy decision too. I mean, they're nervous about Trump's impact, but they're just not continuing to go down. We're basically flat according to his, notes over the last 12 months. So yes, inflation has come down, but not decelerating the way it was in 23.
Right.
And he's nervous about policies and other impacts. Insurance impacts are still going up. Food prices are still going up. You've got avian bird flu, which is decimating dairy cows and chickens across the country right now.
Yes.
You've got these idiosyncratic inflation risks. And also something that we've been looking at for years, we don't think rents and housing are going to come down as fast as even he is still hoping for them. And they haven't over the past year. He thinks in his notes that that's going to continue. But there's a decoupling that has happened in our country. Just young people aren't pairing up the way that they were. There was an article in the New York Times. We've been talking about this for about 3 years now, but in the New York Times about more and more, women solo buying their own homes. It's just a trend that is certainly visible if you're in New York because it's been going on a lot longer than the rest of the country. Women having babies much later, marrying much later, and that means more housing need. So I just don't see supply catching up quick enough. And now with interest rates staying higher, it's going to keep people in those 2.5% mortgages. They're not going to sell their homes. The turnover of retirees downsizing is not occurring because 85% of those mortgages are either paid off or sitting on 2.5%, 3% mortgages. Who's going to trade that for a 7% mortgage?
Right.
Anyway, we think more inflation risk over the next 4 years is really the thing to be weary of.
And if that happened, they not only wouldn't lower rates, they'd probably raise them, wouldn't they?
Yeah, we think the biggest shock to the markets next year would be a Fed hike in 25.
And that's exactly what happened in the 70s. We got inflation down somewhat in the late 70s, and then it came right roaring back in the early 80s.
If you pull up the chart and overlay Volcker's years over Powell's years right now, he's exactly on track. The charts line right over each other for this spike that Volcker got. And Powell is a student of Volcker, and all this guy wants in life is to not be known as another Volcker. He does not want to mess this up. So I think the risk is he'll raise faster than the markets will anticipate. I mean, obviously, the markets didn't anticipate dropping from 4 cuts next year to 2, which is what he projected. So I think Powell's the wild card here, and inflation and how he reacts and responds to it.
And depending on how they react to this cut and Trump's policies, it could go from 2 to 0.
Yeah, for sure.
Or a -1 and start raising. Yeah.
I mean, that's what the 10-year is saying today. I mean, the 10-year is at 453 again today. We're back at last year's highs. Yeah.
Well, we'll see. Well, let's hope that doesn't happen. That would be not good for the country. That's for sure.
Yes.
Well, good. Well, this has been a great discussion. You have a great practice and a really interesting vibe in how to do it. I know many of our financial advisors are always looking for ways, and it sounds like having a real theme behind your firm, and then having a big media. We're in the presence of a media star here, everybody. Yeah, and having a whole media bent to it really has helped you build this firm, hasn't it?
Yeah, for sure.
That's exciting. And then how you mine the gold that's in there, how you connect everyone together. It's really quite interesting. So
thank you, Brian.
Well, thank you. And as I said, we're coming to the end of our show. If you could just give one last thought as to how folks can be successful using like a model you've created and share that with everybody, that would be great.
We run UMA models and mutual fund research models, and I do think UMAs are the product of the future. It's the fastest growing product, according to Cerulli, after passive ETFs. A lot of older advisors got burned trying to use SMAs because of the papering and trying to rebalance or take SMAs out and put them back in. UMAs allow for a seamless one contract repapering, rebalancing, and swapping out of SMA managers. So you can get a lot cheaper access to active management and thematic active management in SMAs than you can anywhere else. And you could do tax loss harvesting to a much bigger degree than you can in an ETF or something. Yeah. So I think UMAs will continue to dominate, and we run UMA models that have thematic access to things that are being impacted by climate risk. And that might not be your bailiwick, but it is something that we do, and it is done well for us. And a lot of clients understand it and appreciate it.
Nice. Well, that's a great message. And thank you. think we'll leave it there. Jeff, thanks for being with us in the Financial Advisors Workshop today.
Thanks for having me, Brian. Really appreciate it.
Thanks. And we'll be back again, everybody, with another great interview with another advisor and a firm just like Jeff. And we wish everybody a great day. And thanks for being with us, everybody. Bye-bye now.